Audio Jungle.
How to find undervalued stocks to invest in. An investment is a financial transaction where the money is guaranteed to be kept secure and a satisfactory return is anticipated. So, purchasing undervalued stocks is the way to go if you want to protect your investment while still making a decent profit. The stock market success mantra of buy cheap, sell high is widely accepted. Every investor dreams of buying a stock at its lowest point and then selling it when it has reached new heights. But how can one find undervalued stocks? Or how do you determine if a stock is reasonably priced or overpriced? In this video, we're going to discuss what are undervalued stocks, how do stocks become undervalued, 8 methods for funding stocks that are undervalued, price to earnings ratio PE, debt equity ratio DE, return on equity ROE, earnings yield, dividend yield, current ratio, price earnings to growth ratio PEG, price to book ratio PB, best Indian undervalued stocks. So stay until the end of this video to know all about undervalued stocks and how you can find and invest in undervalued stocks. What are undervalued stocks? Undervalued stocks trade for less than their intrinsic value. A stock may be cheap due to the company's notoriety, negative news, or a market decline. Fundamental analysis is based on the idea that over time, the market price of an asset will get closer to its actual value, giving traders a chance to make money. It is not sufficient to search for inexpensive stocks to find undervalued ones. Instead of purchasing low-quality stocks that are overvalued, the key is to locate high-quality stocks that are undervalued compared to the market. In contrast, the value of high-quality stocks tends to increase consistently over time. Instead of basing your trading choices on how you feel about a stock, you get all the necessary financial data. How do stocks become undervalued? There are several causes for a stock's decline in price, some of which include stock prices can fall because of things like market fluctuations, crashes or corrections that happen outside of the company. Stock prices may drop because of bad news in the press or changes in the economy, government, or society. Due to the poor quarterly performance of stocks in some sectors, stock prices go through cycles. Stock prices might drop when actual performance differs from expectations. There are 8 methods for finding stocks that are currently undervalued. So how can stock investors identify undervalued stocks? In their fundamental analysis, ratios play a significant role. Stock traders and investors often use these 8 ways to find underpriced companies and figure how much they are worth. It would be best if you kept in mind that the level of competition in each market makes the definition of a good ratio unique. Number 1. Price to earnings ratio PE. The price to earnings ratio is the most commonly used metric for estimating a company's worth. If the PE ratio for a company is low, then maybe it is undervalued. Divide the share price by the profit per share EPS to get the price earnings balance PE. Earnings per share EPS are determined by dividing a company's net income by the total number of outstanding shares. For example, in the PE ratio, let's say you invest in ABC for $50 per share, and the company earns $100 million on 10 million shares. Therefore, the price to earnings ratio is 5, as the EPS is $10 or $10 multiplied by the PE ratio of $50. This means you need to put in $5 for every $1 you want to make. Number 2. Debt equity ratio DE. The debt to equity ratio DE evaluates how much debt a firm has in its total assets. A high debt to equity ratio isn't always bad. It only means that the firm is getting most of its money from other sources and its shares may be undervalued. To prove this, the DE ratio of the firm must be compared to that of its direct rivals. That's because what makes a sound or lousy ratio in one field is very different from another. The debt to equity ratio DE is found by dividing the total amount of debt by the total amount of equity owned by shareholders. For example, ABC is a company with $1 billion in debt and $500 million in shareholder equity, giving it a debt to equity ratio of 10. There would be a DE ratio of 2. $1 billion divided by $500 million. This equates to a debt to equity ratio of 2 to 1. Number 3. Return on equity ROE. The return on equity ROE measures how well a business is doing. Divide net income by shareholders' equity to get a return on equity. If a firm has a high return on equity ROE, it may indicate that its stock is undervalued because of the high level of profit it produces based on the amount of money its shareholders have put into it. For example, ABC company has $90 million in net income and $500 million in shareholder equity. Given these figures, an 18% ROE may be calculated as $90 million divided by $500 million. Number 4. Earnings yield. Since the earnings yield is the opposite of the price to earnings ratio, the two terms are often used interchangeably. Value per share is calculated by dividing profits per share by the price. If the earnings yield exceeds the average profit rate the government pays to borrow money, some investors may see the company as cheap, known as the treasury yield. For example, ABC company has a $10 EPS and a $50 share price. If you divide $10 by $50, you get a 20% return on investment. Number 5. Dividend yield. Dividend yield measures the yearly dividends paid out to shareholders as a percentage of the share price. Divide the dividend payout by the current share price to get the dividend yield as a percentage. High dividend yields are attractive to traders and investors because they show that a company is financially stable and growing. Have a look at the dividend yield example. ABC company pays out dividends of $5 per share annually. When applied to the current share price of $50, these dividend yields 10%, which means $5 divided by $50. Number 6. Current ratio. The current ratio is a valuable indicator of a business's solvency. You can quickly figure it out by dividing your assets from your debts. If the current balance is less than 1, the assets are insufficient to pay off the debts. Stocks with a low current ratio will likely continue falling, perhaps becoming cheap. For example, ABC company has $1.2 billion in assets and $1 billion in liabilities, for a current ratio of 1.2. Number 7. Price earnings to growth ratio PEG. The PEG ratio compares the current price to earnings ratio to the expected rate of future EPS growth. A stock may be inexpensive if it has both high profit potential and a low PEG ratio. The PEG ratio is determined by dividing the price to earnings ratio by the expected rate of growth in earnings per share over the next year. Here's a PEG ratio example using ABC. A company with a PE ratio of 5, a share divided by earnings per share, and an annual growth rate of 20%. To get the PEG ratio, divide 5 by 20%. Number 8. Price to book ratio PB. The price to book ratio PB compares the current market price of a company to its book value, which is calculated by dividing its assets minus its liabilities by the number of shares it has. The method for determining it is to divide the current share price by the per share book value. If the price to book ratio for a stock is less than 1, it may be undervalued. Have a look at the example of the PB ratio. If a share of ABC company sells for $50 and the book value is $70, the PB ratio is 0.71, $50 divided by $70. Best Indian undervalued stocks. Number 1. Hinduja Global Solutions. Business process management is the focus of Hinduja Global Solutions Limited. The company, established in 1973, focuses primarily on customer interaction, digital customer experience, and business process management (BPM). This stock has the best 5-year EPS growth among the top 10 cheapest companies in 2022. It has a PE ratio of 0.94% at 102.4. Number 2. Power Finance Corporation Limited. Power Finance Corporation Limited is a non-bank financial service provider that gives money to other businesses. The company's market valuation is 29,925.32 crore rupees, and it was founded in 1986. Profit per share EPS growth over the last 5 years has averaged 44.35% for this company. It has a PE ratio of 2.14. Number 3. Oil India Limited. Oil India Limited is a fully integrated exploration and production company that works in the upstream oil and gas business. The company was started in 1889 and is now India's second largest hydrocarbon explorer and producer. It has an EPS growth rate over the last 5 years of 31.31%, giving it a market valuation of 20,077.76 crore rupees. The price to earnings ratio of the business is 3.57. Number 4. Zydus Life Sciences Limited. Indian pharmaceutical firm Zydus Life Sciences Limited, formerly Cadila Healthcare Limited, operates worldwide. Both biologics and vaccines are in the company's pipeline. It has an EPS growth rate of 24.71% over the last 5 years and a market valuation of 37,542.65 crore rupees. It has a PE ratio of 8.37. Number 5. MOTILAL OSWAL Financial Services Limited. EPS growth rate over the last 5 years has averaged 28.51%. The market valuation is 11,332.64 crore rupees. The stock has a PE of 8.62. MOTILAL OSWAL Securities Limited offers stockbroking and other financial services. The organization has been around since 1987. it distributes various financial products such as mutual funds, PMS, fixed deposits, bonds, NCDs, insurance products, investment advisors, initial public offerings, etc. Number 6. Finolex Industries Limited. The stock has a price-to-earnings ratio of 9,086.52 crore rupees. Regarding ratio of 8.64, PVC pipes, India's leading producer is Finolex Industries Limited. The firm has been around since 1956 and offers a wide variety of PVC products, such as PVT resin, PVC U-pipes and fittings, self-fit PVC U-pipes for agricultural and portable water supply, ring-fit PVC U-pipes and more. The company is showing an EPS increase of 24.26% over the last 5 years. Number 7. MOTILAL Financial Limited. MOTILAL Financial Limited is the country's most prominent non-banking financial institution offering gold loans. The firm, founded in 1939, has a market capitalization of 41,498.55 crore rupees and a 5-year historical EPS increase of 27.21%. The PE ratio stands at 10.33. This was all from our side to guide you on how to find undervalued stocks to invest in. Remember that the risk of your trades goes up when you leverage, since your gains or losses depend on the total amount of your position instead of the amount you put down at first. Before investing money, be sure you've taken all the necessary precautions. In the end, please subscribe to this channel and press the bell icon if you're new to the channel so you don't miss any new stuff.